Hey all, welcome back to the GMT. We are diving into the private equity interview question. Today's topic is netting off. So, what do you mean by netting off in private equity? So, imagine someone have 1 lakh dollar but also owns $60,000. Instead of making two transactions, would not be easier to pay the net amount 40,000? Is possible in private equity or in netting off? Yes, it's possible. So that's exactly how private equity firm use netting off, and today we'll break it down all the terms of private equity. Welcome back to the channel. We are in the private equity finance and just love learning how big firm manage their books. Hit the subscribe button for the more info. Because today we are talking about the netting off and why it's game changer for financial reporting. So let's not waste much time. So netting off is when the firm offset liability and asset of a partner or investor or stakeholder. So instead of recording the multiple transactions, they just report the net balance. This keep financial statement clean and easy to read. So, is there impact on the statement of financial? Yes, it impacting. Simplifying reporting helps to fewer transaction, cleaner financial for the audit purpose and the day-to-day transaction. Reduce clutter on the balance sheet means if there is balance sheet is there, so in asset you write plant and machinery and all the basic thing instead of recording all the asset at one go, and this will be easier to read and audit easily and find out the error as well. Improve accuracy, but it is must clarifying monitor to avoid overstatement as well as if we are preparing each and every transaction, the statement get large and it is very difficult to audit when it comes to the financial reporting part. There is some accounting exception. Yes, there is some accounting exception as well, but here is a catch: netting off must be disclosed under the IFRS rule and other accounting standard. PE funds are required to report net balance transparently, ensuring investor know what is happening behind the numbers. If you are netting off something, you have to maintain separate statement that how you net it off and what are the condition where you net it off. Is there example? Yeah, Bridgewater Associate practice netting of its accounts to streamline reporting, especially when dealing multiple currency in the investment. So they are dealing into multiple. That's why they are using this netting of the price. So is one of the largest hedge fund that used to netting of streamline reporting without a financial statement should be missed out or maybe mislocated or something. Anything should be not mess up. So here we have a design one is example for the netting off. We'll move to the example part how it is working of netting off. So if GP owns fund of 1 lakh dollar in management fee but also owns $60,000 from the fund, then may net off this amount and report only 40 million. So this is a common example or common practice in PE to avoid unnecessary transaction. So you can take example of fees, credit interest, or maybe return what investor has gained, or maybe anything you can do. If they invest into the IPOs, what stake they have, or how many earning they have, you can net it off among the asset and liabilities. What stakeholder have and what investor have. So this is all for the netting of topic. If you know more about this, you can definitely comment on our comment section. We'll definitely reach out to you. Thank you so much for watching. We'll meet you on the next part.